Welcome to Talk Tickers. So today, we're going to break down the Q3 earnings call for Compass Diversified, that's ticker CODI. And this one, wow. On the surface, the numbers look like an absolute train wreck. But, and this is the interesting part, the market didn't seem to care. Let's dig into why.
All right, here's the game plan. First, we'll look at those shocking headline numbers. Then we'll get into management side of the story, their counter-narrative. After that, we'll see what the market actually did, what the verdict was. We'll cover the path forward from here, and then we'll wrap it all up with our own take, what we call the next call.
Okay, let's start with the headline shock. We're talking about the numbers that dropped after the bell on January 14th, the ones that really set up a mystery for everyone watching.
So check this out. The first big number that jumps off the page, a miss of $1.82 on earnings per share. I mean, just let that sink in for a second. That's not a small miss. That's not a rounding error. That is a massive chasm. Honestly, a number like this is usually the kind of thing that sends a stock into a nosedive.
And this table really puts it all into perspective, doesn't it? I mean, look at that. The GAAP EPS came in at a loss of $1.21. Wall Street was expecting a profit of 61 cents. And then there's the revenue. They missed by nearly $100 million. No matter how you slice it, these numbers are just brutal. So this really brings us to the million-dollar question, right? With a miss this big, why didn't the stock completely collapse? What on earth was the market seeing that wasn't captured in these awful headline numbers? All right, let's move on to management's counter-narrative, because this is where the story starts to turn. They didn't just ignore these numbers. No, they came out with a very specific story, a turnaround story, designed to get investors to look somewhere else. You know, the first thing CEO Elias Sabo talked about wasn't even about the earnings. It was about trust. He made a point to say, hey, with today's filing, we are now current with our SEC filings. This was huge. It was basically him saying, we're getting our house in order, we're moving past the problems. And right after that, he drew a clear line in the sand. He said, you know, our focus today is on our 8 other subsidiaries. This was a brilliant move. He was basically quarantining the problem, telling everyone to stop looking at the bankrupt Lugano business and focus on the parts of the company that are actually healthy. So the strategy, the playbook here, was really simple and clear. Step 1, isolate the problem child, Lugano. Step 2, get back in compliance with the SEC. And Step 3, pivot the whole conversation back to their core job, running those 8 healthy businesses and, crucially, paying down debt. Now, how can they just wall off a whole subsidiary like that? Well, it's thanks to something called deconsolidation. It sounds complicated, but it's pretty simple. Once Lugano filed for bankruptcy on November 16th, CODI can legally remove its financial results from their main statements. It's like surgically removing the bad part to let the healthy part grow. It cleans up the books in a big way. Okay, so the big question is, did the market actually buy the story? Did they believe management over those just awful headline numbers? Well, if we look at what happened to the stock the next day, we get a pretty clear answer. Would you believe it? The stock price basically didn't move. It closed up 1 single penny. After a miss that huge. This wasn't the market being asleep at the wheel. No, this was a really strong signal that investors were already looking past this one terrible quarter. But here's the really fascinating part. Look at the volume. While the price stayed flat, the number of shares traded more than tripled. That tells you the market was paying very close attention. This wasn't quiet. It was a massive debate happening in real time, with tons of shares changing hands as people decided, do I bet on this turnaround story or not? So the verdict is pretty clear, right? All that bad news about Lugano, it was already baked into the stock price. The market knew it was coming. So what investors were really watching for, what all that trading volume was about, was signs of stability and a credible plan for what comes next. All right, so let's get into that path forward. What exactly is this plan that got the market to hold the line? Let's break down what management said they're focused on. First things first, they reaffirmed their full-year guidance for 2025. We're talking $335 to $355 million in subsidiary adjusted EBITDA. And remember, that's excluding the problematic Lugano business. By holding that guidance steady, they were sending a really powerful message. The core business is stable. And then they looked ahead, projecting between $50 and $100 million in free cash flow for 2026. Now that's the number that matters if you're trying to pay down debt. That cash flow is the engine that's going to power this whole deleveraging story. And this cash flow feeds right into their 2-pronged plan to get the debt down. Step 1 is what they call organic deleveraging. Basically, just run the business as well, grow earnings, and use that free cash to pay down debt. But then there's step 2, the accelerator, strategic deleveraging. That means they might sell off one or more of their companies. And when an analyst pushed him on this during the Q&A, CEO Elias Sabo was crystal clear. He said, "I would say everything. Our model has always been everything is for sale at all times. So nothing is sacred." And this isn't just hypothetical talk. There are already reports out there that they're looking at selling the Honey Pot brand, which could fetch a really nice price and make a huge dent in that debt.
Okay, so let's put it all together. Where do we stand on CODI after all this? It's time for our take, the next call.
What you have here is a classic battleground stock. On one side, you've got the bears. They're going to point to the high debt. We're talking about 5.3 times leverage, and they'll say, hey, selling a business in this economy, that's risky. But on the other side, you've got the bulls. They see a cheap stock, a company that's going to be generating a lot of cash, and some really clear catalysts for the price to go up, like selling off a subsidiary.
So with that in mind, our official rating as we kick off coverage is market perform.
And here's why. We think the market is pretty much in a show-me state right now. The bad news from Lugano is in the rearview mirror, it's fully priced in, and management has a credible plan, but it's a challenging one. So we see the stock as likely being range-bound for a while. It's going to need a real catalyst, like a big asset sale, to break out. We're predicting their Q4 results will probably be fine, right in line with guidance, but the stock itself won't do much until we see clear progress on that debt.
And as always, just a reminder, this is not financial advice.